Hey folks, my name is Apur Pandey and I'm back with the next episode. In this episode of podcast, we will be discussing and focusing mainly on mutual funds, and we'll be discussing one important point, which is, are flexi-cap funds better than large cap mutual fund schemes? So, flexi-cap funds allow asset allocation across large, mid, and small caps, whereas large cap funds have asset allocation only in the large cap segment. So, are these flexi-cap schemes better than large cap schemes? In this podcast, we'll be discussing this point in great detail. So, flexi cap schemes are also regarded as pseudo large cap schemes. This is a very common statement, and every fund manager agrees to this point. It's been happening since 2018 when the categorization happened. I have been tracking these funds closely since then, and you would see that these funds have more than 70 to 80% large caps and a very small percentage of mid cap and small cap allocation. So that's why flexi cap funds are usually regarded as pseudo large cap funds. According to Kirtan Shah, the founder and chief executive officer at Credence Wealth Advisors, in the terms of risks, an equal weight portfolio has a slightly higher standard deviation than a flexi-cap fund. But on a rolling return basis, the equal weight performance is superior to a flexi-cap fund. But flexi-cap fund can beat large cap returns. So, in terms of risk appetite, the equal weighted funds have more risk, but in terms of return, flexi cap funds tend to generate that higher alpha, that higher return, because they have some component of the broader markets which are small and mid caps. So, for investors who are looking for alpha returns with consistency, it's important to have a good mix of large, small, and mid caps, which is what a flexicap fund offers to do. One needs to look for a good information ratio and hence good consistency of alpha, not just high alpha, and then participate in this whole winner rotates the kind of the game. That is why flexicap fund offers mid cap and large cap segments as well, and they also have the tendency to rotate as per the market movements and as per the opportunities. So a flexicap fund might sometimes behave as a predominantly large and mid cap fund, or maybe a kind of a multi cap fund. Overall, if we look into the recommendations, so from our side, Parag Parik FlexiCap Fund and SBI Focused Equity Fund, both are the funds which are managed very well, and these two have been outperforming very consistently. So we can target these two funds if we are looking for expanding our mutual fund base into the FlexiCap funds. And I'm not talking about a point to point analysis, but this is what the data shows on a 7 year rolling return basis. So, this is what the rolling return analysis suggests. For viewers who don't know what is rolling return analysis, so rolling return analysis is basically for a particular time frame. We calculate how much will be the returns if the investment start from today, or if the investment start from tomorrow, or second day, or third day, and so on. And based on this, we calculate over a range of 1 year how many days returns would have been profitable or over a threshold. So this is how rolling return gives a good idea, because it predominantly qualifies into the SIP type of thing which many investors do. Now, it's recently a new FlexiCap fund has been launched, which has been launched by the White Oak Capital, which is a new AMC, and its first mutual fund, which is the White Oak FlexiCap Mutual Fund, has been launched. And when asked about the fund manager of and the managing director and chairman of White Oak Capital, Mr. Ashish Somaiya, when it was asked that whether it is the right time to start such a fund or current market conditions suppose that, so he said that I'm afraid that the credit for the timing must definitely go to the regulatory processes, just because SEBI and the process of listing down is so tough and it is so lengthy that the company acquired all the assets and capital of Yes Bank, Yes Capital, when it was demerged. It was acquired in the month of November 2021, but uh, approximately after around 8 to 9 months, in the month of July, the NFO has come. So this is mainly because of the regulatory processes. However, in the hindsight, it does not appear as a it does not appear as a good time, or maybe a bit it uh, it does not appear as a bad time to start such a fund. It appears as a very very good time, if not the best, but very good time, because market is already down by a lot, and many NFOs have been launched in recent times which are down, whose returns are down, and most stocks are looking at are available at very cheaper valuations. So I know that if we look into the specific question about whether it is good time to launch in a flexi-cap category, then the last 5 to 6 years has been quite roller coaster, because where we say flexi cap, obviously it means that we are talking about investing across market caps. However, from 2015 to 16 till 2018, small and mid cap sections did not do very well. From 2018 to 2020, small and mid cap did very badly. There was due to US China trade war and different reasons. And then from then till the end of 2021, small and mid caps till now also seems lagging. The large cap segment has performed more rather than the broader markets. So if we talk about the fund manager, he believes that at White Oak, their belief is that given the kind of changes to macro parameters, and those macro parameters hence puts the cap in and out of favor depending on the macroeconomic conditions and the market conditions, it's very difficult to time which cap should you be investing in. So therefore their belief is that they should run the fund where they have about 30 to 45% in small and mid caps at all points in time, and never really swing totally in favor of large caps or in totally favor of small caps. Considering the small and mid caps have been lagging caps by quite a margin in the last 9 months, from that perspective, it's a great time to be invested in any fund which has substantially small and mid cap. Our industry obviously confuses the matter with having something called multi-cap and then something called flexi-cap. But as per the manager, he says that but at Oak Capital, there's no flexi-cap, multi-cap. There's only one fund which will have anywhere from 30 to 50% in small and mid caps. So, when asked about another question, that is that at the odds with the industry, retail investors would be thinking, what is the USP that this new fund offering brings to the table over the multitude of other existing funds and other bigger AMCs in the market? Because a lot of flexi-cap funds have already been launched in the recent times. If we look at other flexi-cap funds, so Nippon India, Prudential, and even Kotak, all these flexi-cap funds have been launched and they have been performing very good. So to this question, it comes to the USP, Mr. Ashish Somaya said that whatever in the industry today is called flexi-cap, till 2 to 3 years back it was originally a multi-cap. There, because 2 to 3 years back regulations had come wherein a clear definition of multi-cap fund was defined. So there was a point in time from 2018 to 2022 when small and mid cap hit a big slump, and all the multi cap funds ended up becoming something like 80 to 90% in large cap. So then obviously the regulator was right in pointing out that your multi cap funds are looking like large caps and not looking like multi cap. So the regulation came and the rule became that a multi-cap fund should have a minimum of 25% in small cap, minimum 25% in mid cap, and basically if you call it a multi-cap, it has to be all caps. So minimum 25% in all the three caps. The history is that the currently what the industry is running as flexi cap was originally anyway supposed to be multi cap. The only thing White Oak is doing is to launch something which was genuinely what multi-cap was supposed to be, and not getting confused with the nomenclatures. Because even if we call it multi-cap, then again we will have minimum 25% small cap and minimum 25% mid cap. We don't want all those limitations. That is why we have launched one single fund, which will be basically a multi cap fund, but with not all that restrictions and rules. That is why we are launching a multi cap fund with the original thought, but it is predominantly name wise a flexi cap fund. We want a fund which runs like a multi cap used to run, but then don't want to get caught up with the minimum level and the nomenclature and those complications. That's the first thing. The second thing is how it is different. Of course, there is a stock picking process and the investment philosophy, but just bring out the two or three differences. Usually, when a new AMC comes, you have no idea what is the portfolio performance, track record, nothing at all. White Oak's case, it's a bit different because while our domestic mutual fund is coming only now, it is pretty new. As a group and as a house, we have already managed about $5 billion. Within the group, we are one of the larger investment managers for foreign portfolio investors in India. We are already a PMS, that is Portfolio Management Services, and we already have AIFs, which have been running for 3 years. So, in the last 5 years, White Oak has been running global funds investing in India. Within the group, within the investment team, and Prashant, who is our founder and ex CIO of Goldman Sachs, there is a track record. There is a 32 member investment team, which is very well resourced and almost the best resource teams in the industry. The other important thing is that generally everything to do with the fund management is made out to be about stock picking, while White Oak is significantly different. Is that we focus a lot on portfolio construction, because the portfolio is not a list of stocks. If you see in the industry, winners rotate. Why do winners rotate? Because the best of funds and the best of stock picks goes out of gear when the macros change. That's why winners keep rotating. So portfolio construction is a very important, and at White Oak we focus a lot on portfolio construction, such that we are able to generate outperformance over BSE 500 as consistently as possible. In short, there are a few things that one might want to really look at. These are the major key factors. Now, if we talk about the view on the timing of the flexicap fund investing, we what we are telling our clients when they seek the opinion that whether it is a good time to invest in multi flexicap fund or not, or whether it is a good time within the equity landscape. So to this, Mr. Kirtan Shah, who is also the senior CIO at Credence Wealth Management, said that the industry operates flexicap fund as a pseudo large cap fund. So if we compare flexi cap fund and large cap fund, flexi cap is basically a pseudo large cap, partially large cap fund. It's been happening since 2018 when the categorization happened. I have been tracking these funds extremely closely since then, and what you would see that these funds have 70 to 80% large caps and a very small percentage of mid caps and small cap allocation is there. It is ideally not what you really want a flexi cap to do. By the name flexi, you really want to move out with where the macros are moving, and probably take a larger bets on what will really work in favor of the investors and in terms of investing. But unfortunately, the space has not been able to do that on the industry average standpoint. Since 2018, those times are gone where we would say, if you don't understand what and where to put money, put that in Flexicap, so that the fund manager who understands it better will be able to do a better job than you and I will be able to. But that's not what the industry is giving back, because if you look at the industry average, it is a pseudo large cap. Since 2018, what has started happening is that everybody that I know often in my ecosystem, have started allocating money to large, mid, and small caps separately instead of saying to do Flexicap and let the fund manager manage. Even if you look at some basic, very basic data points, we can't go back before 2018 because of the categorization, and it would not be an apple to apple comparison. But if you look at the combination of equal weighted large, mid, and small cap fund, this combination has done much better than what the current flexi cap market offers. In terms of risk, you compare both standard deviations. The equal weight portfolio has slightly higher standard deviation than probably a flexi cap, but on the rolling return basis, the equal weight performance is far more superior to that of a flexi cap fund. Then the point comes, why to do flexi cap in a way whether if it is not part of the industry right now. To share some data on what even Ashish pointed out, if you look at the last 3 years of industry category average of large cap and flexi cap, you will understand that the standard deviation of large cap and flexi is almost the same at 21.3 and 21.4, so it is almost the same. But if you look at the alpha, 1.5% alpha is that the flexi cap was able to generate over large cap. So if we compare to a large cap fund, the standard deviation is almost the same, however the alpha is more. Flexi today, if you look at the risk return, is able to bring in some kind of risk, but has been able to outsmart large cap returns by a stiff margin, looking at only the last 3 years pick since the categorization. While if we look at equal weighted funds, that makes a lot of sense because flexi not operating the way it should be, why don't you replace the large cap category by the flexi? So do you flexi as a large cap and then you allocate money to mid and small cap? I think it's better to have a combination, equal weighted fund, have a combination of large cap, mid cap, and small cap, or a combination of maybe a large and mid cap fund or a small cap fund, rather than having a flexi cap fund if you are looking for more alpha, if you are looking for more risk diversion. However, if you are looking for safety and if you are looking for large cap type of returns, then as per the data, standard deviation of flexicap funds is quite low. However, the alpha, the returns of a flexicap fund are much more in comparison to large cap funds. So the conclusion as per the data is that flexicap fund are almost of the same risk nature, a little bit less riskier, however almost of the same risk nature as per the data. However, as per definition, they are a little more riskier. Return wise, flexicap fund have performed, given much more better return. So risk reward wise, flexicap fund are better choice over a large cap fund. However, if you are looking to diversify the risk, if you are looking to clearly actually invest in a fund which is flexible, it's better to go with a equal weighted fund and a combination. And in order to do this, you can contact your financial advisor or your registered mutual fund distributor. Orchid Research also offers these services, and you can get in touch with us. Thank you so much, guys, for listening to this episode. Hit a thumbs up and show me in the comment section what are your thoughts on this podcast. Cheers and happy trading.